This is Joe from Joe's REPRODUCTION. I hope you're doing fine. If you're new to my channel, make sure you subscribe so that each time I post a new video, you'll be notified. And today we're going to be looking at analysis of ratios. So to enable users to make informed decisions, it is very important to incorporate analysis of ratios with financial statements. So you need to put together the analysis of ratios with financial statements. This is because the financial statements on their own do not always provide sufficient information. The financial statements usually provide absolute figures for a particular period. So for the users to make informed decisions, it is important to incorporate the analysis of ratios with financial statements. So it is very important to incorporate analysis of ratios, and this must be incorporated with the financial statements. Let us look at an example. If company A, we have company A, and we say that company A, the sales revenue, it has 100,000, and if it has a profit, it made a profit of 5,000. And from these two information, from the sales and profit, the users cannot make an informed decision. This is because it's only for a single company, and the reason why the user cannot make an informed decision it's because it doesn't know the amount of sales that was made previously or the amount of profit that was made from the previous statement. So what the analysis of ratios does, it actually compares the financial information. It compares the financial information for a particular company in 2 consecutive years. So it compares financial information of one single company for 2 consecutive years. It can also compare 2 different companies. So it can compare 2 different companies. It can actually compare 2 different companies that are involved in a same business. For example, if 2 companies are involved in car manufacturing, it can actually compare that, or 2 businesses are involved in food manufacturing. So that's the importance of the analysis of ratios. Let us look at another example. So another example, if we have company B, and we have sales. So sales for company B, we have 6,000, and if we say profit that was made for company B is 200, and if we look at company C, if we say the sales were 5,000 and the profit which was made, it was 250. So from this information, if the user has to make a decision on which company to invest in, so if the user is looking for the high sales revenue, is going to invest in company B because the sales were 6,000 in B, and in C they were what? They were 5,000. So if a user is looking for high sales revenue, the investor might invest in company B, but if he's looking for a higher profit company, it might invest in company C. So that's the whole instance of analysis of ratios. So let us now look at ratio classification. So the ratios are classified into different types. So the first type of ratio, we have the profitability ratio. So we also have the activity or efficiency ratio. Then we also have the liquidity ratio. So we also have the gearing. So the gearing ratio is also referred to as the capital structure. So this looks at capital. Then we also have investors ratio. So this looks at the investment. So it's also referred to as the security ratio. So what is the profitability ratio? So these ratios relate to other aspects to try to assess the effectiveness of the business in achieving its central objective, that is generating profit. So this looks at on how profit is generated. Let us look at the second type of ratio, which is the activity or efficiency ratio. So these try to assess the effectiveness of the business in using its assets. They can give insights into managerial policy. So this looks at on how the business is using the assets. Then let us look at the liquidity ratio. So these seek to access the ability of the business to meet its short-term financial obligation. Let us look at 4, which is the gearing or the capital structure. These ratios look at the long-term financing structure of the business and provide some indications on the level of risk inherent in that structure. Liquidity and gearing ratios are sometimes useful in giving an indication of the financial stability of a business. Then let us look at the last type of ratio, which is the investors ratio. So these look at the business from the particular perspective of a shareholder or a potential shareholder. So these are the 5 types of or classification of ratios. So let us look at the profitability ratios. So these ratios are commonly used to assess the effectiveness of the business in generating profit. And there are different types of the profitability ratios. The first one, we have return on capital employed. So that's our first one. So we have return on capital employed. So this is abbreviated as ROCE. So we have return on capital employed, and we find the return on capital employed. So we are going to say return on capital employed is equal to profit before interest and tax divided by capital employed. So this is the formula that we use when finding the return on capital employed. We say profit before interest and tax divided by capital employed. And we know that we can find our capital employed there. So we can say capital employed is equal to fixed assets plus working capital. So that's the formula of finding capital employed, and we know that we can find our working capital. We can find our working capital there. So working capital is equal to current assets minus the current liabilities. So that's the formula that we use when calculating working capital. So let us look at the formula. So we have said the formula of calculating return on capital employed, it's profit before interest and tax divided by capital employed. And we can calculate our capital employed by adding the fixed assets and the working capital. And we can find the working capital by subtracting the current liabilities from the current assets. So the return on capital employed, this is the amount of profit as a percentage of capital employed. Adequate return on capital employed is the reason why the person invested their money in the first place. If a company makes a profit, we do not know how good or bad this profit is until we look at the amount of capital which has been invested to achieve the profit. In other words, this ratio relates the net profit to the level of investment used to earn it. So this type of ratio actually compares the amount of money that you actually invested with the profit that you got. So let us look at an example. So there is an example here, and for this example we have the balance sheet and the profit and loss as you can see. And from this information we can calculate the return on capital employed for 2 years. We have 2017 and 2018. So we know that when calculating return on capital employed, we say profit before interest and tax. So what is our profit before interest and tax for 2017? So for 2017, it's let me just put this. We have 1071. This is the net profit before interest and tax. So we are going to get this for 2017, and for 2018 we are going to get 1445. So we can calculate for 2017. So we can say this is 2017. So return on capital employed is equal to profit before interest and tax divided by capital employed. And we have said for 2017 it's 1071. So 1071. What about the capital employed? So capital employed, we have said this is equal to the fixed assets plus the working capital. So from this we know that our current assets, we have this. So we are going to say this, we're going to say 5,100 minus our current liabilities, which is 1,578. And after getting your answer, that will be your working capital. After getting your answer, you add it to your fixed assets, which is 6,192. And you're going to discover that you're going to have 9,714. So we're going to multiply it by 100, and your answer there is going to be 11.0%. Let us calculate for 2018. So return on capital employed. So profit before interest and tax divided by capital employed. So profit before interest and tax for 2018, we said that this is 1445 divided by capital employed. You just do the same thing. So the first thing that you say your current assets, which is 4036 minus 1959. Your answer is going to be your working capital, and after you do that, you add 7775, and your answer is going to be 9852 multiplied by 100, and the answer there is going to be 14.7%. And as you can see here, we can compare the return on capital employed for 2 years. So here there was a high return on capital for 2018 than 2017. So it means the year of 2018, the business was doing better in terms of profit than 2017. Let us look at return on equity. So that's going to be our B. So return on equity. So this is abbreviated as R or E. Let us look at the formula that we use. So the formula that we use when calculating return on equity, we say net profit after long-term interest and tax. So net profit after long-term interest and tax divided by ordinary share capital and reserves multiplied by 100. And we can find the return on equity for 2017 and 2018. Let us look at the net profit after long-term interest and tax for 2017. So we have 518, and for 2018 we have 838. So we're going to start with 2017, 518. So 2017 return on equity. So profit before interest and tax, we have said that's 518. Let us look at the ordinary share capital and reserves. So ordinary share capital, we're going to find them in the balance sheet. So we have ordinary share capital and reserves. These two, we are going to add them, and as you can see, the summation we already have, which is 7,214. So 7,214, so multiplied by 100. Our answer there is going to be 7.2%. Let us look for 2018. So return on equity is equal to net profit after long-term interest and tax divided by ordinary share capital. Let us look at the net profit after interest and tax. It's 838 divided by ordinary share capital and reserves. So ordinary share capital and reserves. Ordinary share capital and reserves, we have 7852. So we have 7852 multiplied by 100. The answer there is going to be 10.7%. So theoretically, the higher the ratio for the return on equity, the better, since a higher ratio suggests effective trading. So as you can see here, that means that there was effective trading in 2018 as compared to 2017. This is because our return on equity was 10.7 in 2018, and it was 7.2 in 2017. Let us compare the return on capital employed with the return on equity. So return on capital employed seeks to assess the effectiveness of the business in generating profit from the capital as its disposal. As you saw from our formula, we said return on capital employed is equals to profit before interest and tax divided by capital employed. So return on capital employed looks at on how to generate profit using capital. Then it is calculated before tax because the control which management has over its tax charge is limited, and the objective of the ratio is to assess management's effectiveness in terms of use of the capital. Then return on equity looks at the position from the shareholder's point of view. It is more concerned with how much the shareholders get by way of return on their investment after accounting from the previous claims, including interest and tax. So this means that our return on equity for the shareholders will be higher in 2018 as compared to 2017. We shall continue with analysis of ratios, but don't forget to like, share, comment, and subscribe. I'll meet you next time. Peace.